You are listening to KeyStone's Stock Talk Show, episode 252.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
Happy belated Mother's Day to all the mothers out there, my wife and mom and mother-in-law particularly. To start the show, I will hit the viewer mailbag to answer a question on Pivotree Inc., symbol PVT on the TSX Venture. They refer to themselves as a leader in the frictionless commerce strategies, designs, they build and manage digital commerce, data management, and supply chain solutions. A viewer asks what has led to the poor performance in the stock over the past year and essentially since it's listed despite strong growth. Aaron answers a viewer question on Enterprise Group, symbol E on the TSX, which provides specialized equipment and services in the build-out of infrastructure for the energy, pipeline, and infrastructure construction industries. The stock has performed well over the past year, but operates with end customers that have a cyclicality in their business. Aaron will let you know if the growth can continue. Brett answers a viewer question on Western Investment Company, symbol WI on the TSX, a small but diversified private equity company which holds 4 private companies in its portfolio. The company has recently announced a focus on the insurance segment, and Brett examines the plan and the current valuations. Finally, Brennan answers a viewer question on Vitreous Glass, symbol VCI on the TSX Venture, which the viewer states pays a juicy variable dividend, but seems to be trading with a higher multiple in terms of its PE than historic. He asked Brennan if the premium is warranted. All right, let's get to the show. Welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How you guys doing? Do you have a good Mother's Day weekend?
Yes.
Yeah, of course.
Well, mine was busy.
Yes.
My one of my kids had a concert that she was singing in, so
Yeah.
Mother's Day was really spent doing that. So it wasn't as relaxing for my wife as I think
Yeah, for
I would
sure.
have wanted it to be, especially as much as she would have wanted it to be. But still a good day. Still.
Same thing here. We had my daughter was in a play, and her mom was in the backstage part of it, so doing a lot of that the day. So, but then the second half of the day, I made dinner. So, and I tried to clean the house, so that was a good thing.
And it somehow ended up messier.
It was worse,
when you began, right?
And we had my mom over and my dad. So we had a dinner. It was good, and now we're moving on. Mother's Day, it's over, but it should continue for longer, I'm sure. And the mothers out there probably need more days where we make dinners instead of I should do it more is what I'm trying to say. Anyways, moving on. Did you guys want to comment on your Mother's Day? Brett, Brennan, anything?
Not overly. I mean,
no.
There's a nice Morgan Wallen song that I ended up sending my mom on YouTube, and it's a nice song. And, I'm sure she's gonna cry when I'm sure she did cry when she listened to it. But that's about it. However, I would like to briefly mention what a hockey series between the Oilers and the Canucks here.
Well, myself and Aaron actually went to game 2. Of course, the only game of the series they've lost. They've won 2, we went with 2 Oilers fans. Right? Yeah, it was great. It went to overtime. So this series is one Canucks own goal away from being 3-0. So
yeah,
it's pretty impressive. We don't want to jinx it. I'm going to still say the Canucks are ultimately doomed, because if I don't say that, they will be doomed.
I've explained to other people, there's history with Ryan. It's not that he's a negative person. It's just that when he becomes positive, the Canucks performance
it flips.
Decline. So
it goes back
as long
to
as
game.
Ryan's, saying the opposite of what he truly feels, then I think we have a good chance.
That's the point. It's game 2, 2011 Stanley Cup Finals. Burrows scores. We win the game, and I look at Aaron and say we could actually win the cup. From then on, it
Yeah.
went
They were
downhill.
doing great until Ryan
2-0
comment.
series. So we blame me, and I will
Oh.
forever be negative until. And I said, even after they win the cup, I'm going to take at least a week buffer of negativity, just in case there's some kind of steroid scandal or something that's found that negates the Canucks win. I will give it a week buffer, then I will celebrate. So as long as, because my negativity definitely impacts the Canucks, right? So
That's a funny recall moment that you like literally game 2 back in 2011. You look at Aaron saying we can do it. Yeah. And it's stuck in your head. I thought it was also funny.
And I think I always booed instead of looed, but I looed at that moment for Luongo, and it went, he literally went into the tank after that moment. It was awful. Well, I mean, he still played one good game at home. But anyways, let's not get into that.
Yeah, I thought one last thing is I just thought that it was funny.
Yeah,
I thought it was funny because when you guys were at the game and Ryan had been like telling me, you know, McDavid's going to need to take over here in a couple of these games if you know, the Oilers are to really, you know, make.
Well, we give him one. We knew he would in
and it was just
one
funny
or two of the games. That's what
in game 2 there. Exactly, McDavid gets a breakaway, scores a goal, and I had to text Ryan McJesus. And I won't say what he texted me back. It was funny though. Yeah, Mick.
Yeah.
Yeah. Anyways.
And well, you guys still, Edmonton still needed an own goal to win that game.
I know, exactly. Either way, it's been such fun hockey to watch.
But to be honest, this is the last thing I'll say. The third periods of the last 2 games, Edmonton is absolutely dominated. And, you know, our third string goalie, Latvian 23-year-old Artur Shilovs, is standing on his head. It's great to see. It's fun. Well. It is a fun series to watch, and, you know, getting the family to watch and everybody to rib everybody in the office is nice. It's fun. Yeah. Cool. All right. We had a poll last week.
We had a poll.
Brett knows the poll better than me, so I'm going to let him.
He has never seen it, and he has never looked at any of your YouTube comments, so you can keep sending the abusive ones to him and the love
I'm
to us.
Obsessed with all the comments.
He does actually read them, for the record.
Sometimes.
He does.
To him.
Yeah, we send them to him. We make sure he sees your angry messages. Not the good ones, only the angry ones. But
the poll, hate mail.
Yes, the hate mail. So the poll, over the past year, how has your view of the economy changed? 16% improved, or viewed it as improving. 34% say their opinion is unchanged, and half the poll have had their opinion decline.
I'm not surprised, as there was, you know, kind of forecasts of rate cuts coming sooner, and the rate cuts were supposed to be the panacea for when the markets, for example, you're talking about the economy generally, but the markets could have had a rise from them. They have had a rise to some degree anyways, but yeah, I think that the fact that we haven't seen that, you know, maybe plays into that to some degree, at least in from the market's perspective. But Aaron, I think you voted just the same.
Pretty much the same. I mean, you know, it was a year ago when it seemed pretty much like a foregone conclusion that we were going to be entering a recession probably by now. That hasn't happened. So curious to understand why some people's opinions have actually declined over that period. Although maybe some people just, they had rosier views then or more negative views now. But overall, the economy has held up much better than I think most people would have forecasted, given where rates are. You know,
better in the U.S. versus Canada, though, right? Better in the U.S.
and Canada has weakened somewhat, but I mean we're not. Yeah. I mean we're not in a painful recession by any means right now. So the biggest problem we have is still high cost of living and the effects of that period of high inflation, which is increased prices. So inflation has come down, but it's still positive, which means prices are still growing, right? A lot of people think, well, inflation has come down, so prices should come down. No, the rate of increase in prices has come down. So that's the biggest problem that we have. But in terms of our labor market, overall economy, it's not that bad. And then in the U.S., you know, I would say it's fared much better than what most had expected 12 to 18 months ago. But we'll see. We'll see what happens.
And I think, like you're saying, the big difference always is that interest rate sensitivity, because in the US, I've talked about this before, is they have their 30-year fixed mortgage.
Mm-hmm.
We have normally our 5-year standard. A lot of people are even going lower now than that, expecting rates to come down. And that makes it so our interest rate sensitivity, so compared to the bank rate, which doesn't actually completely dictate your mortgage rate, but it is obviously highly, highly correlated. We are more susceptible to those interest rate changes. So our housing prices haven't dropped, but the interest rates have went up. Versus in the US, they have obviously not really changed since you're in your 30-year fixed. So they're paying effectively the same they were in 2020, 2021. If you refinance, and there was a lot of buzz around them to refinance, and a lot of people in the US did, they're still locked in. Where the Canadian ones are starting to roll over, you're now paying 5, 6, 7% depending on your term, compared to 2 or 3% from a few years ago. And that just cuts your spending ability. And yeah, that's, I think, the biggest change between the two countries.
The difference is, it's significant difference. And I don't think it's talked about enough, like in terms of the difference between the way the US has just gone longer and we can't, I mean, not many are going, you're going 5 years here. At
5
max,
years is the standard here usually.
Yeah. And even in the same vein, the US as well, less interest rate sensitivity on the corporate side. They have more financialization, they have more interest rate swaps and so on that are available to even smaller companies than Canada. So you have less interest rate sensitivity there. It's just, you have a bunch of these small effects that make, even though we're obviously very related to the US in many ways, there is quite a big difference in interest rate sensitivity, which is a major effect on the economy in general.
Yeah, it's a point that we kind of should keep hammering home here and talk about the differences, because people think it's just one homogeneous region when it's not completely.
Far from.
No. Yeah. Okay. Should I start, or Aaron, do you want to start this week, or what do you want to do?
Either way, you tell me.
All right, I'll start. I'll share my screen. Okay, well, I'm going to look at Pivotree. What does it do? What does this company do? They refer to themselves as a leader in frictionless commerce strategies, design, builds, and they manage digital commerce, data management, and supply chain solutions. Pivotree is essentially an end-to-end provider of e-commerce, supply chain, and data or master data management services for over 180 large and mid-market retailers, branded manufacturers, wholesalers, and distributors in North America. The company supports clients on a digital strategy, platform design, build, implementation, and on hosting through ongoing support. So the viewer asks here, the stock price is not 121 there. Sorry, we can correct that. It's $45 million market cap, and it's a zero yield. They don't pay a dividend. But the viewer really asks what has led to the poor performance in the stock over the past year, and essentially since it's listed despite strong growth. Let's look at the year chart on the stock. It's down 42%. If we look all time here, it's down. It listed in kind of a boom time in the markets. We can see that the company is down 83% since its original listing. Now, let's look at what is driving this. Well, revenue growth was strong, as the viewer had pointed out. Revenues grew from $49.8 million in 2018 to $101.7 million in 2021. Operating profit fluctuated over that period, but actually trended towards higher losses. Revenue growth turned negative in 2023 and remains lower over the past 12 months, coming in at $85.7 million on a trailing basis. So let's look at the most recent quarterly results. Let's break down revenue here. Total revenue is $20.9 million. That decreased 6.4%. Let's split apart the revenues here. Total managed and IP solutions plus legacy management services. So that would be, they call it MIPS and LMS, of $9.4 million, a decrease of 14.7%. The year-over-year decline was primarily the result of the reduction of Oracle customers as services ramps down this legacy business, partially offset by upsell on existing customers and additions of new customers. The managed IP solutions, or the MIPS, revenue actually grew 38% to $4 million in the quarter from $2.9 million in Q1 2023. Legacy managed services revenue, again, declined 33.5% to 5.4 million from 8.1 in the same period last year. Now, professional services were also down to 11.5 million. That's a decrease of 17.7%. The year-over-year decline was primarily due to the ramp down of professional service projects and delay closing of current pipeline of deals. It had a delay in that regard, which was only partially mitigated with growth through existing and new customer bookings. If we look at the net loss over that period, 2.2 million compared to a net loss of 1.4, so a higher net loss primarily due to the timing of third-party costs and increased contractor spend to support growing professional services revenue, which contributed to reduced gross profits. Adjusted EBITDA was about 200,000 compared to an adjusted EBITDA of about 900,000 in the prior year period. So let's look at the balance sheet. The balance sheet is relatively strong. Cash is about 7.9 million, just marginal debt there. So about 7.1 million in net cash. Let's look at the valuations here. EV to revenue is 0.4, EV to adjusted EBITDA. This is based on an estimate. It seems to me like a very optimistic estimate, the one estimate that we see out there. So I put a question mark beside that. The PE, there's no earnings, so no way to calculate a PE. That's trailing. Looking forward, not expected to have positive EPS this year. So that really gets to a quick conclusion on the company. From our perspective, that will summarize the story on Pivotree in terms of its declining share price. Well, the company had experienced solid revenue growth. In the near term, revenues are now declining, and the company is yet to post significant positive cash flow and certainly no earnings. Over time, this leads to a lower share price, no matter what story you are telling investors. Now, Pivotree has shifted to product. Its product shift, the shift in the product mix here strategically is gaining momentum. The company generated 4 million of managed and IP solutions. The MIPS revenue, that was up 38% in Q1. And they signed 2.9 million of booking in this newer growth area of the business. But there is ongoing LMS declines in 2024, and they should balance out over time with growing MIPS contributions, but consolidated revenue is still expected to decline in 2024. For us, with declining revenues and no profitability at present, we would take a pass on Pivotree despite the reduction in share price and the low EV to revenue base that the company trades at with a solid balance sheet. We need to see some profitability before we would look at Pivotree.
Yeah.
All right.
I guess the question comes down to like, how are they funding, the cash burn?
Yeah. I mean, cash has gone down year over year from about 15 million to that net cash position that I showed there. So
yeah. And just looking at like the share count here, I'm just looking, it doesn't look like it went up too drastically, but Q3 of 2020, we're looking at about 23 million shares outstanding. We're now up to, 26.5 million shares. So, they're still issuing. I don't know if that's...
Yeah, I mean, they had a significant cash balance there.
Already.
They're draining it, right? So, I mean, that's...
Eventually, they may have to more aggressively issue shares.
Sometimes I see these companies that go public, smaller companies, they get it happened to be a good time in the market to go public. They get a probably more cash than they needed or deserved at the time, and it's more deserved. And then they, you don't have a discipline to produce a bottom line because you've got this cash war chest sitting there. And they just, whether it's management trying to gain market share or whatever they justify, they don't have a culture within the business to be profitable. And when you don't have that, it is hard to gain it back over time. And again, there are legacy business issues going on here and, investing in a new business, but you've always got that type of thing going on in a business. I'd prefer a company that has profitability and gain their cash hoard through internally generated cash. You can't always have that, but it's certainly not the case here. And the company has never produced profit or cash flow. And that's why, the market eventually looks at you and says, can you make any money off the business you're doing? You're growing revenues, but can you make any money? And that hasn't been the case here. And it's not surprising to see the share price go down, particularly when you couple that with now they have declining revenues, like from their peak in 2023.
Yeah.
Brennan said the question is, how are they funding growth? I don't think that's the question.
Because there was no growth in the last couple of
time
quarters.
Talking about it when revenues are declining and there's no earnings.
He probably means
the business.
It's a good exercise to explain why we have the criteria that we do, which is based on profitability. And of course, if you're not making money, you have to fund. You have to cover expenses from somewhere. That's going to be from increasing debt, or it's going to be from selling shares, and that's not a sustainable strategy. So,
yeah, I mean, they're trying to fund the one area of their business that is, they've pivoted to where there is growth. But again, like that cash balance will run out quite quickly, developing more software if you continually lose money, right? So, and that's, kind of what's going on here. And until they can show that, and if they get in a situation where they're not net cash anymore and they have to go to the equity markets with a lower share price, then it becomes a spiral. So, there better be a higher discipline towards having cash flow positive from at least from operations, or just I would have good free cash flow in this business, but they're not doing that right now. So we'll monitor Pivotree.
Yeah, just to give an idea on how much cash they've actually burned through, their market cap is currently at 45 million or so. At the end of 2020, which was after their IPO, they had 54 million in cash. So if they just sat on the cash for the last 3.5 years, they would have been doing better off than what they are now. Just to give an idea.
Yeah, that is a real. Oh man, that's a great example of of course they're saying we've been investing in growth
and got about a 5% pre-tax profit margin, which is better.
Of course they're saying like we're investing in this, we're growing the business, but you have to prove it out, right? You have to prove that out over time, and eventually like revenue growth.
GICs in a public company structure, so.
And the sad thing is like Pivotree isn't like the worst example of a TSX venture or TSX listed company. There are far worse companies than Pivotree out there. At least this company is doing revenue, coming close to adjusted EBITDA. But, it shows you how good you have to be to really increase your stock price over the long term and create cash flow and earnings, like where you have to get to. This company is, has a revenue base, but they're not growing profitability. So that's what you need. Or, the business really isn't profitable right now. All right, let's shift on. Aaron, you are looking at Enterprise Group. True? Not Enterprise, the rental car company, which, they'll pick you up, I've heard. But Enterprise Group, Brennan needs a pick-me-up right now. That's what I'm saying.
Yeah.
But Enterprise Group, which is you are
correct,
infrastructure, energy pipeline company, right?
Yes,
correct.
Pipeline less so nowadays. So there's a bit of a history here. So and I'll get into that. But Enterprise Group is actually a company. I remember going to a presentation that they put on probably back in 2007. And at the time they were pipeline construction, but they've changed the focus of the business now. But anyways, we'll get into that. So Enterprise Group is the company that I'm going to cover here. The symbol is E on the Toronto Stock Exchange, trading at $1.20 right now. It's a micro cap, 70 million market cap, 58 million shares outstanding, no yield right now. So what they do is they provide specialized equipment and services for energy infrastructure projects, essentially, and construction. And they have presence across Western Canada with a concentration in Alberta and northeastern British Columbia. So looking at the company over the last year, tremendous performance, up from about 45 cents to $1.20. So they've been doing something right over the past 12 months. If I want to extend this chart going back a full 15 years, we can see that the picture is somewhat different. A lot of volatility in this name over that period of time. But I'm gonna make a couple of points later on here in my slides that really demonstrate why this chart is not relevant anymore. But it does really show how oil and gas service can fluctuate quite a bit. And we always say energy services companies are really some of the most risky in the oil patch, often riskier than oil and gas producers. But anyways, we'll talk a little bit more about what the company does specifically right now. Let's take a look at the financials. They just put out their Q1 financial highlights. Good, strong performance pretty much across the board. Revenue up 23% to 12.3 million. Adjusted EBITDA up 43% to 6.3 million. Higher EBITDA margins and a little bit of growth in earnings per share up to 7 cents from 6 cents. So 17% year over year growth. These Q1 results are coming out after a strong 2023. Again, strong performance across the board. Revenue growth of 25% to 33 million. Adjusted EBITDA growth of 64%. Big increase in margins, and then 140% growth in earnings per share to 12 cents, up from 5. So very strong performance there. Looking at the balance sheet, I would say the balance sheet is healthy. I have no concerns here about the balance sheet. Cash of 10 million, total debt of 24. I do notice there's some mortgages in there, so there's different types of debt. It does appear that some of this debt would be collateralized by fixed assets like properties, land potentially. 51 million in equity. So I would say that the balance sheet leverage is reasonably healthy. I'm going to say reasonably healthy because the net debt to EBITDA ratio is below 1 times. It's 0.9. Debt to equity of about 0.5. Now, when you're looking at an oil and gas services company, particularly a microcap like Enterprise Group is, you want to see low leverage ratios. You want to see a strong balance sheet because there are historically we would expect to see big fluctuations in financial performance, right? And even periods where they're not making money in terms of net income. So servicing debt when market demand starts to decline can be very difficult. Put a lot of these companies in real dire straits. So 0.9, I would say this is probably like the max what I would want to see for leverage ratio. Generally speaking, below 1, I would still consider healthy. Ideally, for a company like Enterprise Group, I'd probably want to see below 0.5 or even a net cash balance, not a lot of debt. But, generally speaking, I don't have any major concerns, at least in the foreseeable future here with the balance sheet. And then valuation. So based on the share price, $1.20, trailing 12-month earnings of 13 cents. So that's a price to earnings of about 9 times. Adjusted EBITDA trailing of 15.2 million. That's enterprise value to EBITDA of about 6 times. So valuation seems reasonable. Again, when we're looking at a microcap oil and gas services company, we would expect to see a low valuation, certainly below 10 on a price to earnings basis. All conditional on what the growth level is, the visibility of growth, and some other factors about the underlying business, like our revenues based on long-term contract. But generally speaking, when you're dealing with a cyclical industry, and particularly a microcap in a cyclical industry, indicating there may be not a lot of diversification in the business, we would want to see that reflected in the valuation. So, 9 times earnings, 6 times EBITDA, I would say that's probably about reasonable, but I wouldn't consider that to be extremely cheap, just generally speaking. But let's take a look at what the company actually does, do a little operations overview. So there's 4 segments to the company right now. There's Evolution Power Projects, Westar Oilfield Rentals, Arctic Therm, and Hart Oilfield Rentals. So Evolution Power Projects, this is the newest segment of the company, established in April 2022. So essentially what this segment does is it provides power generators to oil and gas services projects and infrastructure. But the difference is that they are using natural gas powered generation, whereas the standard is typically to use diesel fired generators on these sites. So they're saying that there is better efficiency, reduction in emissions by using their natural gas generation over diesel. And that's a competitive advantage that they're claiming that they have. Another company here, another segment, Westar Oilfield Rentals, acquired in October of 2024. So this is a oil field equipment rental company. Again, Hart Oilfield Rentals, oil field equipment rentals, acquired in January of 2014. I won't get into like the specific. There's a wide range of equipment that I believe that these two segments rent. And then Arctic Therm International, which was acquired in September of 2012. So essentially what they do is they sell heating units, thermal units to oil and gas projects that are in northern areas where it gets very cold. So they have their own proprietary thermal units that they sell or that they rent, that they believe are well suited to those conditions. But the oldest segment in the current company is September 2012. So when I was showing you that long-term price chart going back to, I think, about 2008, really, it's a completely different company now. They've completely shifted their focus. I remember when I was listening in on the presentation, they were specifically a pipeline construction company. It doesn't seem that is really the focus of the business right now. Rather, they are providing services and equipment to oil and gas infrastructure and construction projects. So just going through some of the statements from the company here, just to be clear, these are the company's statements. They are not mine. So I have not confirmed all of this myself, but these are things that we would look into. The first is that they consider themselves to be the leader in a mobile site infrastructure to the Canadian energy sector, and they believe that they are the sole provider of low emission site electrification systems. So this goes back to their natural gas power generation equipment that they rent out or that they provide. So that it would be a competitive advantage if they are indeed the sole provider. This is something that if we were going to further our research, we would look into what other types of competitive projects out there, how there are out there, or how accurate this statement is. They referred themselves as remarkably profitable with substantial margins and rapid expansion trajectory. I'd say the margins look very strong. Certainly, they're producing good profitability right now. They refer to favorable trends in the energy market and avenues for them to go into expansion into new markets. They're also looking at both organic expansion and expansion via acquisition. So they have made acquisitions in the past. They are open to adding to the business as well with acquisitions in the future. They also highlighted the management and insider ownership, which they say is now exceeding 35% and growing. So that's very strong insider ownership. We like to see management have a good solid stake in the company because it aligns them well with shareholders. So that's certainly a positive. Our take on Enterprise Group, well, certainly recently we've seen very strong financial performance. The margins are good. The balance sheet reasonably healthy. Again, we would expect to see low leverage for an oil and gas service company. I'd say reasonable valuation. Again, we would expect to see lower valuations for an oil and gas service company. We like the high insider ownership. Generally, I'm seeing what are strong fundamentals across the board in the current market environment. That said, this is a cyclical industry. We see demand fluctuations, quite extreme fluctuations when it comes to oil and gas service, more so even than for the producers. Typically, not for all oil and gas service companies, but generally for the industry as a whole. So the cyclicality of the industry is really what we would consider to be the biggest risk. We are going to see some fluctuation, or we would expect to see some fluctuation in financial performance. So that would be something to be wary of. And then I just said as well here, that it may be fair value for a microcap energy service stock. We would want to see that price to earnings below 10. So, at 9 times, depending on how they grow over the next couple of years, it's not necessarily what we would see as especially undervalued. Now, in the current market, if the energy patch remains strong, then they have opportunities to continue to grow, and the share price should continue to do well. But again, demand can drop off quite significantly, and we've seen that in the past. It can be very detrimental to small companies in the services space. So our take, really, I am seeing positive fundamentals across the board, with the caveat that we're in an upswing in the industry. That can change. So this is a company we would just continue to do further research on. We would look at, what other types of competitors are out there for their products, what the acquisition market looks like for them right now, and just generally how they expect to grow. But this is a company we'll be monitoring, and we did have some communication earlier in the year with the company, so we may reach out to them in the future.
Yeah, I think it checks off a lot of boxes. We'd love to see it net cash because of the cyclicality of its kind of end markets, and that's why there is a bit of a discounted valuation. There should be over time because there is some boom and bust in the business. Perhaps that ends this time, but I've heard that before with many companies, and then you see a downturn and they are affected. So. Yeah, I think it's a decent company, and I think there's been growth there. Can it continue? There's typically ebbs and flows or cyclicality to its end markets. So it typically has businesses that service volatile end markets have some volatility. Maybe not as volatile as the end markets, but they have volatility.
And I think that's really, as far as oil goes, since it is servicing specifically the Alberta, and I guess, well, I would throw Saskatchewan oil sands a bit in there just for Brennan, even though there's not much there. It is expensive oil to produce, so it's very sensitive. Effectively, they're more operationally leveraged compared to other international oil producers. So you're looking at $50, $60 a barrel at the lower end, and cost to produce. So if you start to see oil really drop into that range, they won't add additional supply. Those might start to cut back on even higher current operations if they expect it to keep on going, because there's obviously startup and shutdown costs implied. So if you start to see a long-term trend of for any oil producer, any oil-related services, in especially the Canadian oil sands, we're normally the first to start to cut production, as it is just more generally expensive than international producers. And right now you're seeing Saudi Arabia and OPEC in general have actually quite low production. That's been quite in the news. So if they do start to increase production, there's a ton of geopolitical and obviously economic background for that. So obviously it's very complex. But if they do start to increase production, that can hurt oil services companies, especially in Alberta, even though they are doing everything right. And that's something you should really look to. Even if oil is still doing well, if it starts to just drip slowly down, Alberta will be the first to be hit more than any other company. And that's what I really would stress here for any service company, is they'll start to see it quite quick.
Right from our man in
Alberta.
Yeah, well, take it from Brett, because he's right there right now. And yes. Brennan is somewhere that we don't. Is Saskatoon a real place? We're not.
Nobody really knows.
Sure. Yeah,
you guys want to know about lentils? I'll tell you all about the lentils.
Yeah, well, you're the lentil boy, man.
Yeah,
man, the lentil man, right?
Yeah.
All right, but you now, Brennan, or I think we're doing Brett, right? Brett, you're gonna do the Western Investment Company, so you might as well just
more
continue
West.
Talking.
Yeah, just more Western Canada.
All West.
That is what it is, and the great name for this too, Western Investment Company. Perfect.
It's of Canada.
And it is based in Calgary, which is where I'm at. Just throw that out there as well.
You can go visit them.
Exactly. You never know.
You could go to a Foothills Creamery, right?
Yeah,
Although that's a small part of the business.
It's a small part. So
small.
We'll get into it. So like Ryan was just saying, they are a private equity company. So they have 4 underlying private companies at its time in its portfolio: Fortress Insurance Company, Glass Masters Auto Glass, Golden Healthcare, and Foothills Creamery. It is symbol WI on the TSX Ventures at 58 cents a share and a $17.2 million market cap, with a slight dividend yield of 0.86% at this time. For companies structured like Western Investment, the financials are generally structured a bit different from when you would usually see, as they are generally relying on equity income compared to you'll just have consolidated income, which is what you're probably used to seeing. And it'll be a bit different for other financial companies, of course. But you need to look at their financials a bit differently than your standard company. So for 2023, the company had $1.8 million in income from equity investments, an increase of 46% from 2022. So that's really the income which the 4 prior companies, which I mentioned, come into what their ownership share, Western investment Canada's ownership share gives them. So they got 1.8 million from those companies. And then they have their corporate expenses on top of that, which lower Western Investments Canada's income to $200,000. So to break down the financials a bit further, we need to look at the underlying companies. Western Investment owns 55.3% of Glassmasters, 25 to 30% of Golden Healthcare, 49.5% of Foothills Creamery, and 28.5% of Fortress Insurance for 2023. I'll get into that. It changed a bit since these results. Golden Healthcare's range, it has a range because Western Investment holds 30% of 3 Saskatchewan senior care homes. Brennan is unfortunately not in one of those quite yet, but maybe soon. And then 25% of Golden Healthcare Management, and then groups them for earnings. The following figures are based on 100% of the underlying companies, and you'll see this a lot for these equity type investment companies, is they'll break down what their share is, but then they'll give the full results, or at least a group of results for their underlying companies at 100%. So you need to be aware, because you'll see sometimes they'll quote in press releases 100% of the revenue, and you'll have people take that as they got 100% of the revenue when they only own 10, 15% of the company. And you need to be cautious of that for any of these equity holding companies. But the majority of the company's net income comes from Glassmaster. They had net income as well as promissory note, which can be continued in perpetuity. And this, they just call that, they group into one investment income. And that it was 1.9 million, growing from the prior year's 1.5 million. And revenue grew as well for the 100% of business at 21.3%, and effectively doubling the non-interest income aspect of that investment. Golden Healthcare had net income of $150,000, up from a slight loss in the prior year. Foothills Creamery also performed well during the past year, flipping to an income of $789,000 from a loss of $1.8 million on the back of growing revenue at 8.3%. Last but certainly not least, Fortress Insurance increased their net income of $719,000 from a loss of $383,000. Gross written premiums, which are from the insurance contracts they write, grew 26.4% from 22.4 million or to 22.4 million. So overall, strong year for the four businesses. You saw growth across the board, which is always good to see. You saw top line, the respective top lines all grow, as well as bottom lines. However, the company is undergoing a massive change, to say the least. The company is receiving at least $20 million investment from Paul Rivett, founder of Tavir Capital Corp, which could potentially increase his investment stake to $23 million, depending on their choice. In tandem, the company is issuing rights for existing shareholders to purchase shares at 40 cents a piece, which could add another $30.2 million in capital. Remember, the market cap for this company is only $17.2 million. So you're adding upwards of 23 million plus another 30 million. It could be a massive change in corporate structure or capital structure, as well as corporate structure. And even if there are no rights executed, the investment from just Paul Rivett is larger than the company's entire market cap at this time. In addition, Paul Rivett will become president and CEO, while the former CEO, Scott Tenness, which is actually a Canadian senator, will be appointed chairman of the board for 5 years. Paul Rivett is interested in the insurance side of the business and that will really become the focus of the business going forward. As well, the company is required in part of this transaction to acquire 51% of the underlying shares for Fortress Insurance, and it has since secured 59% of the shares conditional on the closure of that transaction. As a part of the potential acquisition of Fortress share rights for the Western Investment shares can be either paid in cash or voting rights in Western Investment at 40 cents a share, just like the underlying rights that are issued to shareholders, which could potentially add upwards of another 30 million shares to Western's count. So we're seeing just a complete change in their capital structure as well as their corporate structure during this time. There's significant change, to say the least. The company is, however, planning to still keep a hold of Golden Healthcare, Foothills Creamery, and Glassmasters as long-term investments at this time. So you're not seeing them clean out their other investments just to bring in insurance. They are at least still holding on to them for now. Further, the company does set out some targets for Fortress. Gross premiums written, so that's effectively the top line for the insurance companies. You can use it it is different, but you can use that as a top line kind of. They were planning to increase it to $100 million annually by 2028 through both organic and inorganic growth, ergo acquisitions, which is very substantial from 2023's 22.4 million gross premiums written, effectively 4.5 times what they were doing. And so you can see they're planning to massively increase their insurance business. Whether they can do it or not is really the question. So concluding, the company is undergoing significant changes, to say the least. The trailing valuations at this time are effectively meaningless, but they're not exactly cheap. You're looking at 85, 90 times on a price to earnings ratio. Obviously not cheap, but quite a few of the companies are just near that break-even point. So you do get those big fluctuations in price to earnings or really any other valuation metrics when it is near that zero line. So it's not saying it's completely overvalued, hopeless type of company. It is growing. The underlying businesses, they've grown top and bottom line during this time. But that's not really the question. What you want to be looking at this time is those businesses. You want to be looking forward. So you need to look at the complete capital structure change, whether or not this transaction even goes through. I would say it's very likely, but there is always a risk when you're looking at these big transactions, acquisitions, M&As, any of those sorts of things. Even if the market has it priced in at 95, 100% chance of happening in its price, sometimes they do fall apart. For whatever reason, it could be capital falls out, a death, anything. It is not 100%. So I would personally like to wait through for the transaction to at least close and then further see the progression of Fortress, see if they can actually build up to that 100 million gross underwriting, see some progress there, see them deploy the capital because they're coming into a lot of capital. The amount obviously varies depending on the rights executed. If they can actually deploy that in insurance business. Because if the transaction goes through, they can't deploy the capital effectively, you're stuck with a dud still. Transaction falls apart, you're stuck with a dud, or at least it fit in the company in a different form than what you would have expected. So at this time, I'd really wait and monitor the company for some progress in the transaction as well as after the transaction.
Yeah, I think at this point, it's a good summary on the company, but you're betting on the new business, essentially the new business going forward and management. And, we'd like to bet on some cash flow existing in the operation. And we need that as a basic premise in any investment that we have. It's just not here yet to the degree that we'd like to see.
Mm-hmm.
And the certainty isn't there yet either on it going forward.
No, and that's really what I mean is I don't think it's a bad company. I'm not going to lambast it or anything. They obviously have some good the individual companies that at least have some cash flow behind them. But whether or not they can do it in this structure and then build out the insurance is really the question.
I mean, these companies we love to monitor, and if they hit an inflection point in the business, or they're not getting any coverage and they're trading at valuations that they indicate they could be a good long-term situation. That's why we keep a book on a ton of these companies. But until we see, it hasn't checked off all our boxes yet, is what we'd say. And I think you went through that well. All right, Brennan or Aaron, did you have any comments on that? We're moving on, right?
Move on.
Yeah.
I think I put him to sleep there.
Yeah. Vitreous glass, Brennan.
Yes. So sticking on the Western Canada theme. So we got this question.
Go west, young man. Go west.
Yeah, exactly. So we got this question from Colin on Twitter. Or I mean, maybe you would want to call it X now. But he says, I would like to hear one of the Flatland Prairie Boys review microcap VCI or Vitreous glass. Pays a juicy variable dividend. Seems to be trading at a higher than historic PE ratio. Is it warranted? Crushed glass. Who wouldn't like that? So I'll get into it here. We have featured Vitreous in several of our comprehensive annual cash rich reports as a monitor report for clients. So, we were just monitoring. So clients should be somewhat familiar with the company. And I know that Ryan has interviewed management several times in the past, going back several years as well. So Vitreous Glass, VCI on the TSX Venture, currently trading at a price of about $5.22, a market cap of about $32 million. And the company operates a waste glass processing plant in Airdrie, Alberta. The plant gathers post-consumer waste glass, crushes it, removes contaminants, and sells the final product to manufacturers of fiberglass building insulation for use as a raw material in their production facilities in Alberta. So the stock price has performed quite well since pre-pandemic, up just under 40%. And really the question is, what has been driving the stock price? Well, strong housing starts in Western Canada and the Northwest United States that spiked in 2021 has helped the company post good growth in its financials. And I'll show you that here. So here's a chart of the housing starts. This is just in Canada. And, given the company sells its final product to just 3 manufacturers of fiberglass building insulation, the company has very high customer concentration. So this is a risk. And as I just mentioned, sales are heavily dependent on housing starts in Western Canada and the Northwest United States. Now, despite the current lack of housing supply in Canada and the US, or given the increase in interest rates, we have seen housing starts remain relatively flat in early 2024 compared to calendar 2023. And of course, if we look back to 2021, during the year, Vitreous announced that it experienced unexpected additional demand by 2 of its main customers. Again, it only has 3 customers, driven by an increase in housing starts in Canada and the US. And as indicated by management, they stated that the levels of supply of raw glass and the levels of demand by Vitreous's customers will continue to fluctuate beyond the control of the company, and these fluctuations are not susceptible to prediction or forecast by the company's management. So keep that in mind as we're going forward here. Now, looking at the financials, the last quarter was Q1 of 2024. Revenue was down 20% to $2.34 million. Earnings per share was down 18% to 9 cents per share. And cash flow from operations was a gain of $184,000, down from $781,000 for the same period last year. And looking at the valuations, trailing 12-month PE is about 13.7 times. And on a price to cash flow basis, the stock trades at about 12.3 times. And of course, it has a nice dividend. The trailing dividend payout ratio from earnings is approximately 95% right now. So historically, Vitreous has traded with a median trailing PE multiple or price to earnings multiple of about 12 times. So considering, like I said, I calculated it at about 13.7. It is currently above its historical valuation. And in the conclusion, I'll get into that a little bit more. Looking at the balance sheet, it remains very healthy with $1.68 million in net cash, which equates to about 27 cents net cash per share. And we do not see any real uses for the cash other than potentially supporting the dividend. As you could see from the company's long-term revenues, there really hasn't been much growth in the business at all. So to conclude, overall, I think that Vitreous is an intriguing micro cap. The company has an attractive dividend yield of 6.8% and a trailing payout ratio of 95%. The balance sheet is healthy with net cash per share of 27 cents. Revenue growth has been relatively stagnant long term with a compound annual growth rate of just 2.5% from 2014 to 2023. And the company really has no long-term expansion plans. The company's current PE multiple of 13.7 times is above its historical median PE of about 12 times. And I think for a company like this, I would really try to catch the stock on a dip rather than a potential peak, given the unpredictable nature of demand for its recycled glass. And of course, the lack of growth expected from the business. So, Colin asked, do I think that the premium valuation is justified? I don't really think that the premium is warranted. That's just in my opinion. Now, of course, risks that I would like to highlight for Vitreous is that it is extremely illiquid. Only a few shares basically trade per day. Demand for its recycled glass can be quite volatile, and it has very high customer concentration with just 3 customers, like I said before. Now, investors with high risk tolerance looking for a green or recycling stock with an attractive yield could consider Vitreous glass, but we continue to monitor given the risks and just overall lack of growth. But it's an intriguing name, definitely, and it's obviously been, we've been monitoring it for years and years. But it would be awesome to see the business really be able to grow further than what they have been able to.
Yeah, it'd be nice to
Yeah.
see some type of an expansion plan there. And
Yeah.
dividend payout ratio of 95% would make me nervous in terms of just the sustainability of the current
Mhm.
dividend, given that, they only have so much ability to predict what their earnings are going to be going forward.
Yeah, exactly. And that's the thing. It is variable. We could see, that it come down here going into the future. I don't know.
Now, on the
Um,
flip side, one would potentially think that housing starts should be stable to higher in the future,
yeah.
given that we have such lack of supply. We need to build more housing, but you know,
Yeah, it's tough to say.
Yeah.
But I do agree with that. You'd
I mean, it's
expect
just,
to remain.
sorry, the lack of growth long term is, I
Mhm.
mean, 8.2 million in revenues in 2014 and 9.6 trailing right now, 2.7 million in operating income in 2014. It's 3.1 today. It's not a bad company, but like Brennan said, like if you're going to buy this business, it trades by appointment.
Mhm.
So, if somebody who owns a relatively significant for this business amount of shares wanted to sell, I would buy after that
Yeah.
when you have an opportune entry point and buy for the dividend. But now, does it deserve a premium multiple? It's not premium to the market, but premium historically for this company. Probably not, unless you see some expansion plans. So if you really wanted and love this name, I would look for it on a more significant dip, and you could see it in an illiquid name like this at some point.
Yeah, just to give an idea about how illiquid it is,
Yeah.
it traded a whole 402 shares today. That's not 1,000, that is 402 shares.
Yes,
So about
shares.
$2,000. The bid ask spread was $5.05 to $5.30, which is just massive. That's
Yeah.
huge spread. It normally would be about 5%. And that's what you'll see with these super liquid stocks is market makers will do a 5% spread or even a 10%. As well on the dividend, it is variable. So I'm guessing if they did see a downturn, they would just cut it.
100%.
So like at the start of 2023, you saw 19-cent dividend for the quarter, then 11, then 6 cents. Then the last 3 quarters have been 10 cents each. So even if you are an income investor, you're not going to get consistent income in a company like this. And I think if they were ever to find some expansion opportunity, you would probably see the dividend cut or even removed for a time being. That wouldn't surprise me either.
Yeah. Agreed.
Yeah. And it is really still small. What is the
It
market
was like
cap?
32 million, I think.
Yeah, I mean, it's only
32 million.
9.6 million in trailing sales in that range, right?
Yeah.
So, I mean, it's not like it's trading at, like, sometimes these illiquid situations, we see a company trading at like 0.3 times sales or something. This is trading at a multiple off of sales, right?
Yeah.
So, yeah, not a bad business. It's done well over the long term, but you're really in there for that dividend. And I think the CEO himself likes the dividend. He's a significant shareholder, and he's taking cash out of the company through that dividend, which is his right. But there's not enough growth here really for us to be interested at these prices.
Yeah. It's interesting just with like the home builders. Like I know that there's another company in Canada, which we've been talking about, Ryan and I, where it's just, they've been reporting bad numbers, but yet the stock has continued to kind of go up. I wonder.
Some of them, yeah.
Well, some of them. Yes, exactly.
Yeah.
Some of them. There's a few names. And like even just looking at like the premium that we're looking over the historical multiple, like Colin said, I wonder if maybe that's taking place here a little bit. Again, I don't know. I'm speculating.
It could be, yeah.
But it could be. There might be
Yeah.
some increased sentiment towards these home builders or whatnot.
I think Vitreous, I know this, we've talked to them years ago, but I think they're selling down to US customers, are they not?
And yeah, both.
Yeah,
both,
the end
and
customers,
Yeah.
So it's down to US. And I think some of the companies that we looked at that have had higher valuations than historical were servicing the Canadian market. Because like Aaron was talking about, the demand here would be, the need for more homes where we are right now, right? Particularly our affordable housing is great. But this is a long-term trend, but at present, you've seen a pullback in spending because of the higher interest rate environment generally in the construction sector. And so you're not seeing those get built right at the moment. So there is, you see some of these companies that are anticipating a longer term by the end of this decade, more housing needs to get built. but their financials don't show it right now because higher interest rates affect the ability to raise capital to go out and build these projects. So it's a bit of a strange situation where you see lower numbers, and some couple of companies that we looked at that, there's parts of the businesses that look good, but you're significant decline in revenues and profitability, and your share price went up in a volatile end market. That is risky. Maybe we'll touch on that in a future podcast. Those companies specifically. All right. That's going to end it, I believe, for this show. I think that's all. There's no one else waiting in the wings to present, right?
Doug?
I'm going to say that every week. Doug?
Yeah,
Is Doug coming?
Just kidding.
My dog could come in and present. That would be great. All right. That'll end it for this week. Again, we thank you for watching, viewing, listening. If you're watching this right now on YouTube, smash that subscribe button. If you're listening on iTunes or wherever you consume your podcasts, rate and review. And like I say, as always, only positive reviews. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.